Good morning, good afternoon, and good evening to our audience. Welcome to the third session of day one of the Manulife Investment Regional Investment Conference. My name is Peter Kim, Head of Institutional Business Asia Pacific ex Japan. The topic for the session will be on private assets in Asia as we continue to see interest from investors, including Manulife. Today I have with me Myron Ju, who is our private markets Asia head. He will be speaking on Asia's private assets and how it's become an interest in the region and globally. Towards the end of the session, we do have a Q&A, so please feel free to ask questions using the Q&A function. So welcome, Myron.
Well, thank you.
So Myron, private assets or private markets continue to be an attractive asset class. Institutional investors in Asia are looking to private assets for higher returns to help manage risk and to diversify portfolio. Can you elaborate on this, please?
Sure. Fundamentally, I think there are key three drivers behind this trend. The number one is really the outperformance. Private markets has continued to generate strong outperformance compared to other asset classes. I can show you some data. For private equity, the average IRR for the last decade is about 10%, with a 7% standard deviation. If you look at MSCI, the World Public Equity Total Return Index, it's only generate about 8%, but with 13% standard deviation, much higher risk. If you compare that to a Sharpe ratio for public equity investors, you can see the private markets are much better investment asset class. And also currently with the low global interest rate environment, all the investors looking for yield, and private markets actually offer that as well. And secondly, private markets start to have much more stronger breadth and the depth. In the last decades, you can see there's a rising allocation among institutional investors going to the private markets. There was 6% back in 1999, and as of 2019, last year is about 23% allocation. And also there's a significant increase in the LP universe, more than 3 times more LPs investing this in the last 10 years from 2008 to 2018. And separately, if you look at the underlying investment universe, increasingly there are more institutionalized general partners with much stronger depth and the more diverse investment options and strategies available for investors to choose from. And lastly, the private market actually capture most of the growth recently, and most of companies tends to stay in private much longer than before.
So within private markets, it's our expectation that private assets in Asia will continue to grow and significantly grow. So maybe you can tell the audience in terms of why you believe that investors should keep a very close eye on the asset class.
Very simple. First is really about portfolio diversification, right? Asia currently represents about 21% of the total global private market market share. And that is compared to about only 9.2% back in 2007. And the total AUM actually more than doubled just in the prior 3 years. But separately, there's also very fundamental regional growth. Asia allocation is expected to further grow as it contributes for nearly 50% of the global GDP, with the fastest growing economies in the world, right? Lastly, look at the global trend. Prior 20 years, we talk about globalization, but now, in my view, the next 10 plus years is about deglobalization. That leads to more direct exposure with an asset allocation into the Asia market. And more importantly, if you invest in Asia, it gives you the exposure into China, which is the second largest world economy, which dominates the Asia private markets business with the largest market share. Frankly, in my personal view, with the recent COVID and the trade war, which I think it could mark a turning point for Asia private growth in the next coming years.
So you raise a good point there. So maybe you can help elaborate in terms of why you think the trade war and the COVID situation could actually be a turning point for significant growth in Asia?
We look at this more from a macro level. First, if you look at the fundamentals in Asia, there's a very favorable demographics and also increasing local consumption power. And also look at the current US dollar situation. I think there's a risk of potential weakness of US dollar in the longer run. And meanwhile, in the Asia part of the universe, it is self-contained and a much more sustainable economical ecosystem, which will benefit the local business despite the initial pain during the business transformation caused by trade war as well as COVID.
Great. So, what is the impact on private markets from the pandemic, and can you compare it to the global financial crisis?
Yes, we did do some detailed analysis, and we look at predominantly from four factors, which is fundraising, investment activities, exit/realization, and impact on return. Across most of these factors, I would say the COVID impact is significantly less than the global financial crisis back in 2007 and 2008. If you look at the fundraising front, there was a slowdown, but less so compared to GFC. Back in the GFC, there's 35% of the manager who has raised capital through the crisis or prior to crisis actually never be able to raise another fund again. Right? I don't expect we see that this time. The investment activities as well. There's a dramatic drop in investment activities, down more than 35% back in 2009, but quickly recovered by 2010 to 2011 to the pre-crisis level. We have seen a similar sharp downturn amid COVID, more because people just cannot travel, right? Also, the private credit part of the opportunity is likely to come back first, in my view. Meanwhile, this time, the valuation of the general private markets continue to sustain reasonably high due to the low leverage and the better interest coverage. And there's easy loan terms is available compared to global financial crisis. Separately, with the large drying powder in the private market space, that give further additional buffer to the market downturn. Then, if you look at the exit and the realization front, during the global financial crisis, realization activity declined by more than 50% and took up about 4 years to recover. And that impacts IRR while the net multiple continued to remain reasonably steady. But if you look at COVID this time, there's virtually no exit in the first half of this year. But there's signs of very strong IPO market and rebound that we start to see the realization in the private markets as well. The last one, the factor is about impact on return. Fund raised pre-global financial crisis has underperformed the market long-term average in general by about 300 to 400 basis points, and which leads to a sub 10% net IRR. But meanwhile, for the funds actually post the global financial crisis, the vintage year between 2010 and 2012 generates about 200 to 300 basis point outperformance compared to the average. 35% of LP currently anticipate a very moderate decrease in return during the recent Preqin survey. And surprisingly, quite majority of LP, 85% of them, say that most of their returns so far has met or even exceed their expectation.
So, obviously, Manulife is very interested and has many capabilities on the private asset side. Can you maybe explain Manulife's approach to private assets and potentially how clients can take advantage of that or join kind of forces with Manulife?
Well, as a large global institutional investor ourselves, actually we take a more, I call a risk-adjusted approach to have a diversified private markets exposure, which ranging from real estate, infrastructure, private credit, private equity, timberland, and agriculture. Currently, we have over 100 billion exposure globally to the private markets assets. We have a strong preference for cash yielding strategies for our own long duration general accounts book, which is really the insurance premium book. And meanwhile, we also have full alignment interest with our investors as we invest side by side with significant amount of capital with our investor into every single strategy that we do. Hence, we'd be happy to explore a potential partnership with like-minded investors to extend our investment capability and share our deal flows across some of these sub-asset class by bespoke the segregated mandate arrangement or partnership discussions.
So I think this is maybe the question of the day, and I'm probably stealing somebody's question, but which asset class within private markets in Asia would you recommend?
Well, we really like private credit and the thematic-driven private equity strategy. And also, more importantly, actually, we are very keen towards the clean energy, renewable infrastructure, and the digital infrastructure space. On the private credit side, that is a strategy can potentially offer very attractive risk-adjusted return if the deals are being properly structured and executed. For institutional investors and the clients, this asset class can offer scale and ongoing cash yield. On the private equity side, we like the disruptive and the new technology and the business model, which can help to transform some of the large traditional industry with improving efficiency. That would be very interesting, which I think there's still a long leg to go. And also, I mentioned the clean energy, renewable, and the digital infrastructure. This actually is a very exciting space. Maybe I can share with you actually one couple slides. As you can see, I think we are going through, I call a energy transition in the next 10 years. A lot of people look at energy sector, it's a commodity sector, which was true, right? But there's a number of things happening along different segments or subsegments of the industry that will have very profound impact of the business on go-forward basis. For example, showing on the slide, there are improving energy efficiency, and meanwhile, we start to see a steady increase in power investments and the demand. More importantly, the renewable actually start to mature, both in terms of the technology as well as the cost is coming lower. It's already reached the parity to the traditional fuel energy, right? And also, there's a decreasing cost of the storage, which actually going to play a very significant complementary segment to help even further to help the adoption of the renewables. Then the energy digitalization as well. We are not going forward to view energy as a commodity. You can potentially have different quality of energy, and you can digitalize the energy. And lastly, there are increasing requirements for the power quality as well as the reliability of the energy sector. And maybe we move to the second slide here. If you look at this slide, maybe some you might be aware, but I think that this slide is very telling. If you look at between 2007 and 2011-12, actually Europe has been leading the world in terms of investing in the renewables. But then between 2012 to 2017, you look at the China number, it dwarfs the rest of the market, right? So that actually has contributed significantly to the cost of renewable has been continued going down at a 10% plus a year. That brings this industry is very attractive, and we expect a transformative change in the business model, the innovation, and the potential player in this space on a go-forward basis.
Thank you for that, Myron. So, and last but not least, and then we'll start taking questions from the Q&A. But as investors start building their portfolios in Asian private assets, maybe you can offer a few recommendations as they build out their portfolios.
Well, I would advise people to take a portfolio approach with appropriate diversification across idiosyncrasy investment strategy with proven managers, and then create a very balanced portfolio to optimize the ongoing cash yield with option to capture the additional upside through private equity. So by doing so, you can also help you to reduce the volatility of your portfolio, significantly lower the risk, but meanwhile capture the upside.
Great. So that's the end of the questions from us. We have some questions that I believe the audience has put up. So thank you for your presentation, Myron. The first question that I see here is, I noticed that you pointed out China clean energy as being your favorite asset class. What does Manulife have to offer?
As you may see in the news, actually, we have recently partnered with in my view, the best team specialized in the China renewable investment and the development arena. And this team actually has brought proven investment capability with industrial operational value add know-how. Right? It is a go-to team in China, even by some of the international peers. That how good these guys are. And currently, the team is in the process of obtaining the SFC licensing as with partners to set up a new entity. And upon the completion, we expect to launch a new product early next year.
Great. So the second question that I see here is on the risk side. So what are the risks? What's the drawback of investing in private markets in Asia?
Yeah, no, there are probably about 4 key risks associated with private markets or private equity investing. Number one is about liquidity risk. It's a very long duration asset. Investor needs to be patient. It could be quite lumpy in terms of cash flows. So you need to, again, it points you need to have a very diversified portfolio to even out the lumpiness and the liquidity risk. Second is a lack of transparency. Unlike the public market, it's highly regulated. Private markets, there's very lack of regulation, lack of transparency. So you need to really partner with someone who knows what they're doing and be able to add the value and identify potential key risks and mitigate these key risks on your behalf. And thirdly is about counterparty risk. In the private markets, every single deal you're facing counterparty. So you need to be extremely careful about this. The lastly is about, we need to seek for a trust manager to partner. And hopefully that partner will also bring the proper alignment interest with you, putting their own money side by side with you. That's the best way, in my view, to mitigate these risks.
Okay, so the next question, you have mentioned about Manulife has over 100 billion exposure in private markets. Can you elaborate more about your current capabilities?
Yeah, actually, we have a very diversified and a comprehensive investment strategy within private markets globally, right? We have North America infrastructure, we have US senior loans, US office Singapore REITs, timberland, agriculture, and etc. And recently, as I mentioned earlier, we also acquired the best local team to cover the China renewable and the clean energy space. And they will also have a sleeve for data center as well. All these teams actually have very long-term proven track record. Quite a number of them has over 25 to 95 years, right? For example, we have 95 years experience for our real estate investment business. We have 30 to 35 years in infrastructure, timber, agriculture investing, and then 20 plus years for private equity and private credit.
Great. The next question is, you have also mentioned about infrastructure, private equity, and private credit. What is your thought on real estate?
Actually, that's a very interesting question, especially some of the real estate segments has been impacted by COVID the most, especially around the hospitality arena and the retail as well. And the way we see it is with the COVID, actually, we anticipate potential behavior change post the COVID, which will have very profound impact on real estate subclasses or sub-asset class segments. All these also create investment opportunities in the, I would say, 3 key segments. Number one is logistics. We start to see people stay home longer, order more stuff through the internet, and the adoption of e-commerce is just sparked. Right, that will be continue on the upward trend. And the second, we expect there will be likely a more deep valued long-term lending and the restructuring for a very diversified premier hospitality portfolios, because this probably is one of the lifetime opportunity to be able to buy some of these high quality hospitality assets. If the COVID with vaccine coming out, market start to be normalized, these assets should not be traded at the level as they are right now, right? And then lastly, we do start to see, even personally, I don't know if you guys observed, we start to have a very blurred personal life and the professional life, given we spend a lot of time working from home, right? So in the past, people are comfortable with a small flat in the city center, but we start to see these days people looking for slightly more spacious room, maybe outside the city center. So that means there will be likely new demand for new multifamily housing configuration and design on a go-forward basis. That could be another interesting segment to watch out for.
Okay, so I think this comes to the end of our session. I want to thank you, Myron, and obviously we want to thank the audience, especially our audience staying up late in North America. Please do. We appreciate any feedback on this session. There is a tab, which is a polling tab on your screen. So any feedback would be appreciated. Again, thank you very much. I hope the conversation was helpful to the audience. And last but not least, please stay safe.